We're starting our recording. And you are being, we are recording, just so you're aware. So always keep an eye on your mute, because one of the problems whenever you do online classes is invariably, not here, but somebody leaves their mute off, and there's something going on in the background. It becomes part of the recording. So always keep an eye on that. But at any rate, we're talking about ratios today. And what are ratios? Let's share our screen. Okay, you guys are in. I'm glad that you found it. I'm glad that you're here. Okay, so let's go to the screen. Okay. So can you see my screen? Can you guys see my screen?
Yes.
All right, great. All right. So if you can't see anything, because sometimes it kind of gets wonky, let me know. All right, so what is horizontal analysis, right? Financial statement analysis is the process of examining a company's financial statements to develop strategies. So really what it is we're looking at ratios. We're looking at things like income statements, cash flow statements, balance sheets, and we're trying to compare it vertically and horizontally. So what does that mean? It means like on a horizontal, think about what horizontal means, right? It means that, like, when you go to the beach and you look out at the horizon, you could see the back, right? That's the one time we could really, it's very easy, unless you live in like Montana. It's very, where, you got the big, I've been up there, like Wyoming, where you could see out, or the Great Plains. Most of the time, the best way to see a horizon is at the beach. You look out, and at one point you see it ends, right? It doesn't actually end. It's curved. The earth is curved, but there's an horizon. So whenever you think of horizontal, think about that, So we're looking at numbers over a period, the same numbers over a period of time. And that's really what horizontal analysis is. We're looking at ratios and numbers over a long period of time. So as we look at them, we can start to compare how a company does over a long period of time, as opposed to vertical analysis, right? And in vertical analysis, we're looking at common sized analysis. So we're looking at things where we find our financial statements. And usually what we do is and break in and talk to me if you have questions. What we do is we look at sales as always as 100%. So if we start with sales as 100%, then what we'll do is we'll back off and we'll say, okay, if sales are 100%, then how much is cost of goods sold as a percentage of sales? How much is legal expenses as a percentage of sales? How much are commissions as a percentage of sales? So now we can compare our company with any company, because no matter how big or small the company we're comparing with is, we're always going to look at it as a percentage of the sales number. So that's all. That really is simply, when you hear horizontal, vertical, it could tend to get a little wonky. But when you think about it simply like that, always break it down. Always break down your learning, right? It makes life so much easier. When you break it down, you start to see that this isn't as difficult as you thought in the beginning. It's just a function of how we're going to look at these numbers. So one thing I wanted to show you, something I prepared, just like a little extra help from me. And I believe, I put it in, bear with me. Let me stop here. I believe I put it in the messages. Let's see if I got it there. Okay, there's my overview. All right, that I did put in. But let me put this in the announcement so you have it. So this is additional help from me, right? On this whole subject. Let me go back. Sometimes I think I put things up, they're not there. So we'll go here. And I'm going to stick it here too, so you have it. Because we don't have discussions in this class. Because I think it's a function of we're doing a brand new program with McGraw-Hill. So I think that kind of enough work for you guys. So, I think that was the decision that was made. So studying financial ratios is essential because they offer valuable insights into a company's financial health and performance. These ratios allow for the evaluation of how well a company is doing in terms of profitability, efficiency, and liquidity. By analyzing financial ratios over time or against industry benchmarks, one can identify trends and determine whether a company is improving or facing challenges. Ratios also standardize financial information, making it easier to compare companies of different sizes, which is what I just told you. That's the one good thing about a ratio. I can compare a small, cola company with Coca-Cola. I can compare a small airline with American Airlines because now we're dealing with percentages, right? We have to adjust, obviously, as analysts. A small airline is not going to look like have the same profile as American Airlines, but they're both airlines. So to some extent, it's helpful. And this helps us make informed decisions. Additionally, financial ratios help assess a company's ability to meet short-term and long-term obligations, providing a clear picture of its financial stability. For investors, ratios are vital tools in evaluating the potential return on investment and associated risks, aiding in determining whether a stock is overvalued, undervalued, or fairly priced, which is really what we're looking at, right? Every time we do a financial analysis, really what it comes down to, again, break it down. We're looking at an asset, whether it's a company, whether it's a piece of machinery, whether it's an employee, and we're trying to figure out, is this overvalued or undervalued? Now, people are not machines, but there is the cost of physical capital, human capital, and we have to understand, and most times when an employee isn't performing, I should just digress for a minute. It's usually the fault of the management. You have to figure out a way to make you have to most employees need guidance, in the sense that this is what we need you to do. You just can't leave an employee, without a lot of guidance and then say later, well, you didn't accomplish an objective. It's up to you to make that objective work and measure that objective. And it's the same thing with an asset or a company. And the best way to start doing that is usually through ratio analysis, which not only helps us understand what the company is about, but helps us to understand how it looks against its peer group. All right. So if you click on this, I have a video. Could you guys hear this? Could you guys hear this? Hello? Okay, hold on a minute. Can you hear that? Okay. No, you can't hear it, right? You can't hear it. All right, let me see. I want to make sure it's... Hold on one sec. I'll make sure. I get so paranoid when I don't... Okay, good. We're recording. Let's try this again. Okay, so... Hey, we're sharing tab audio. Let's try this again. Okay, let's try this. Just somebody speak in the mic and let me know that you can hear it.
Look at me.
Yes, I can hear it.
Okay, great. So let's watch this little video that I created, only because I want to make sure you watch it. Okay, this is Professor Strafacci, and I wanted to go over a list of financial ratios. I found this website. There's a ton of websites that talk about financial ratios. Obviously, this is one that I'm using, but you could look at just about anything. And in of course, our textbook is most important. But just to go over how to look at financial ratios, I want you to understand that you have to look at ratios in an absolute sense, not in an absolute sense, in a relative sense. And spoke there for a minute. So like a doctor would look at a blood test. There are obviously some numbers the doctor doesn't want to see, but on the other hand, there's no question that they have to take into account the whole patient. I mean, the history, where the patient's at, what they're dealing with. A white blood cell count may not matter if they're in the middle of a flu. It might matter if there shouldn't be an issue. And why am I saying that? It's because when you're looking at financial ratios, you want to take in a more holistic approach. So for instance, you have your profitability ratios, and you have your current ratios, and obviously I want to stay current, and it always seems like it's a good idea to have more current assets, and it is, but then again, you have to look at it in the context of the business you're in and what your competitors are doing. It's not just an absolute number. None of these numbers are absolute.
So for instance, on receivables, it might always look like a good idea to collect your receivables quicker, but if you're pushing your clients too hard to pay their bills, they may decide to, decamp and go to another competitor that offers better terms. So while it's a good idea, you want to also be able to sit down with each of your clients and decide if it's the best idea to have push them for another 10 days or 15 days to make those numbers look better. Another one would be inventory turnover. Obviously, it looks like a great idea if I turn over inventory quicker. That would be a good idea, no question. We don't want to carry a lot of inventory. It could be dead weight on the shelves or for an auto dealer in the parking lot. But on the other hand, if I'm not carrying enough inventory, and my clients might not like that idea. They may want to see choices. You walk into a store, you want to see choices. Otherwise, what was the benefit of getting in a car and going to the mall or going and looking at a car deal? So you have to be careful when you look at these numbers, not to use them absolutely, but to use them relatively and to make them the starting point of the questions that you ask. Another one is accounts payable, accounts receivable, accounts payable. Of course, we'd like to delay our payables as much as possible.
So on accounts payable turnover, accounts receivable, it really is a function of how quickly you're, like for instance, when you offer accounts receivable, what you're doing is financing your clients' purchases. So if your sales are much higher than your accounts receivable, let's say you have accounts receivable of $10,000, but you're making $100,000 a month, you're basically turning over those receivables 10 times. Because assuming you're collecting all your receivables, those receivables might stay at the same level, but 10 times a month you're kind of collecting, you're turning over those receivables. So therefore, is a low number good? Is a high number good? That's not the way you want to look at ratios. It's not the way you want to look at ratios. You want to look at them like a doctor would look at a blood test relative to other things. Now, you might have a lot of long-standing customers who use like a month or two to pay you, which is fine. There's no problem with that. You're getting paid. You manage your credit and you manage your cash conversion cycle in a way that allows you to run the business with those credit terms, and it moves on. Maybe many supermarkets takes up to 60 days to pay for their. I mean, most of the supermarkets that make money off of float. I'll talk about that in a minute. But now, if you get a new manager that comes in, all of a sudden wants to collect these receivables sooner, and it makes it much tougher, or doesn't want to pay their payables because it's the same thing. I owe the money. How often am I paying that money? Well, what ones or I'm not turning over my inventory quick enough, so I decide I'm not going to carry as much inventory. Those things could be detrimental. So having better numbers just on an absolute basis is not a good idea. What it's a good idea is, as an analyst, to look at those numbers, compare them to your peer group, which is other companies in the same industry, and then go ahead and make adjustments. So say, for instance, inventory turnover, one could argue, well, I could get better out. I can get myself better inventory turnover if I carry less inventory. But we all know when you go to shop for a car and you get to the lot and there's not enough cars on the lot, that becomes an issue, right? I want to be able to look at a bunch of different ideas. I don't want to just look at one. I don't want to just sit there and look at, if I only have one car to choose from, I might decide that I'm going to go somewhere else. I just don't like the color, or I don't like what's in the seats, or, whatever it is that it is. But when you go to another store, another dealer's lot, and he's got more cars, you wind up buying the car because you say, that's what I wanted. That's exactly it. Make me a deal. So the point is, even right when you go to buy a dress or a suit or in the supermarket. So knowing how now inventory is dead money. If I don't sell that inventory, it's just money that sits there. So what I have to be aware of is the fact of how much inventory. And there are specialists that spend their whole careers managing inventory. So just saying, this company has better inventory turnover than another company is just not good enough. You have to kind of understand what's indigenous to your company. It's the same thing with accounts receivable. If you get some aggressive manager who says we should be collecting these receivables sooner, that could become a real problem, because what winds up happening is your clients who have been with you forever say, hey, I've been a great client. Why are you pressing me for these receivables all of a sudden? So you have to always put it in terms of what makes sense and your peer group.
But on the other hand, we don't want our suppliers to start wondering if we can make our payments. That may look bad with your reputation in the industry. So all of these things have to be taken into effect when and into thought when you're looking at different issues. So another one that I like to point out is the asset turnover number here, number 9, when net sales over average total assets. Again, a number you would want to see two companies. One company has a high asset turnover, another one, company B, has a low asset turnover. Obviously, we would want to take a look at company A because we think that's a better idea, but we might find out that company B had just put in new factories, new production facilities, in which case that would make their net sales over average total asset would lessen it, right? You have a higher denominator. But it also means that company B has new stuff, that they could be more effective, they could be more efficient, that in the future they're prepared for, you know, take for instance a production facility that's been revamped. It's going to be a more efficient facility that'll be around a lot longer. Where company A has old equipment, and they're going to be paying that price at one point. They haven't upgraded, you know. So again, asset turnover is a number where it just starts to question. Doesn't kind of, you know, obviously, if you look at it over the course of the whole industry, you get a better idea of where it should be. And in the end, what ultimately matters, debt ratios are important, times interest is important, but earnings per share, you know, that's where you really know what the market value is at. And I like that. And price earnings ratio is the most important, I feel, because it's what the market thinks. It's where the market is betting their money. And if the average price earnings ratio right now is around 25, which implies about 1 divided by 25 is a 4% return on the market is, you know, requiring your stock to return 4%. Well, if it's higher than that, then the market obviously feels your earnings are going to grow and that you're in a better competitive position. And if it's lower than that, then they think that you're a mature company. And you may want to look into why they feel that way. So if you're gauging a company, price earnings ratio is really important. So that's just a preview.
That's another very important ratio, which is a price earnings ratio. Now, why is that important? Because it allows us to measure how much our market value actually is. So for instance, and let me go to another screen now. So for instance, right now the market trades at a, I want to trade this one. Okay, good. The market trades at 24 times, about 24, 25 times earnings, which means for every dollar of earnings in the S&P 500, which is a broad cross-section of the market values of the companies, the companies in this that trade in the market, investors are willing to pay $25 for a dollar of earnings. So if you do the math, you're getting about a 4% yield on earnings, right? Because if I earn $1, my company's earned $1 and I'm paying 25 for them, I'm getting about a 4% yield. So if the rest of the market, so right now what concerns me personally, and this is why we look at ratios, if the government's giving me 4% in 10-year treasury bills, right? You can give the government money for 10 years, and they'll give you 4%. Plus you get a state tax deduction, right? Government securities have state tax deductions. Well, then that concerns me, right? Because I'm getting the same thing. Why would I take a risk in the markets? Now, one could argue that the stocks in the market will grow, but that's kind of baked into the price earnings ratio as far as I'm concerned. The only thing that mitigates that is you got stocks that are ridiculously valued, like NVIDIA or a Tesla, which are 30, 40, 50 times earnings. And then you got stocks that are pretty reasonable, like Ford or Lockheed. So, you know, and some of the oil companies. So, you know, you have to kind of understand the market. But price earnings ratios really do help you understand. Before I move on, can you see my screen and are there any questions? Right now I'm showing your classroom screen. Any questions? Hello? I can't see a chat, so if someone could talk in the mic, it would really help me. It's just I want to make sure you're seeing what I see.
I don't have any questions.
All right. Can you see my screen?
Yes, yes.
All right, great. Thank you so much. So let's take a look at ratio analysis again. I mean, it's really the theme, right? And there are liquidity ratios. One of the most important is your current ratio. So your current ratio is essentially what your current assets are over your current liabilities. So if your current assets are like things like cash, anything that's liquid, treasury bills if you have them, if you're a bank or if you're a company that wants to put cash full, that has cash but doesn't want to have it all liquid, like you have a savings account. All those things that are immediately liquid. And this week's keyword is liquidity. This week's keyword is liquidity. Liquidity, liquidity. If your current assets are should be X and your current liabilities, which is money you owe out immediately, is Y, you divide them up. Now, basically, you want to see, and there's no hard and fast rule, but a two-time ratio is usually a pretty good idea. Because think about yourself personally. You're going to have cash in the bank, and then you're going to have money that you owe out. You generally want to have at least 1.5 to 2 times cash compared to what you're going to have to pay out. Because that's going to, so this way you make sure you're always liquid and you always have money for whatever investments that you need, okay? So the current ratio is going to be current assets over current liabilities. So that's an important one. And all you do is you take your current assets. When you open up any spreadsheet or when you're doing your homework, just look at the balance sheet where it says current assets, because that'll have lined up. It'll be the first stuff that comes up. And then look on the other side and look at current liabilities and just divide it. That's all you have to do. Now, the acid test is interesting. What we do is we take cash plus our marketable securities, right? Which is generally what you're taking current, but plus your net receivables over your current liabilities. So an acid test ratio is a measure of a company's short-term liquidity. The acid test ignores slow-moving inventories. So you're taking out basically your inventories is what you're doing, okay? Because, and why we call it an acid test, just by way of history, is years ago when people were mining for gold and some people were trying to, like everything else in life, there were always these guys who painted things to look like gold and they weren't gold. The person who paid them for the gold, the exchanger, they would put the thing in acid, and if it faded, then they knew that it was fool's gold, what we would call it. So it's the same thing. We take out inventories because, as I said before, sometimes inventories can be valuable. Sometimes they could be dead money. So if I have a company like a jeweler, let's say I'm a jeweler, or like Zales, well, if they're holding on to gold and things like that, I would count the inventories because we all know gold is fungible. It's like a currency. Or if I was running a brand like a Ford dealership or a General Motors dealership, I would count the cars because they are fungible. They are liquid. But if you're running something where, it's like produce or even like fashion, you may have to take a discount or not count those inventories at all. So, because it's not really something you can make liquid. Remember, the thought is, can I make it liquid and can I pay my bills? Then you have the current cash debt to coverage ratio. So you have your net cash provided by operating activities and the current liability. So every month you're going to owe certain money. Think about yourself personally again. It's the easiest way to think of these things. And use this as a reference. So now you have these current liabilities, right? You know that you're going to owe out your mortgage or your rent. You know that you're going to have to pay your utilities. You know you're going to have to pay certain things that are going to come up every month. So how much cash am I earning from my operating activities, and what do I have to pay out every month? That's an important thing, right? We want to know that, and that's the current cash or debt coverage ratio, okay? And then I have a receivables turnover ratio, which is my net credit sales, right? That's my sales net. What I've given to my receivables, what I've offered my clients in credit versus what they paid over your average net receivables. So what we're really saying is we're looking at how often I'm turning over my receivables, right? My net credit sales, it's my sales after credit over my receivables. So again, using my previous example, if I'm making $100,000 in sales and I've got an average of $10,000 in receivables, I know I'm turning over receivables 10 times a year. Now, is that the same as everybody in my industry? That's a question for me. If it is, that's good, right? At least I know that I'm not more aggressive or less aggressive. Maybe I have competitors that are more aggressive and they're doing more business for that reason. And I got to start examining why I'm not. Maybe they're less aggressive and they're doing more business, and I got to examine why I'm being so aggressive. Sometimes not having a good turnover receivables is a red flag, because maybe a company's just offering out a lot of credit to keep their earnings up, and they may not collect that stuff. Sometimes it's just a regular form of business. That's why you want to look at a horizontal analysis, because if I can see those numbers are steady throughout a number of years, I could be more comfortable with that ratio, right? That's why we look at horizontal analysis, so we could see if that ratio holds up over a period of time. Then we have inventory or inventory turnover, which we talked about, which is how much the items that we're selling cost me versus my average inventory. So if my inventory is always about 100,000, and at the end of the year I sold $500,000 worth of goods, I've essentially turned over my inventory 5 times. Now, one could argue that having a better inventory turnover is good, right? Because I did say to you, inventories that wait. But remember, the proper amount of inventory for your peer group and for your business. You want to make sure, if you walk in a store, just use common sense here. If you walk in a store and there's not enough stuff on the shelves, and everywhere you go, I'm trying to buy this and I can't find that, and I'm trying to buy that and I can't find that, well, you're not going to walk out of that store. You're not going to want to do business. Now, if there's too much stuff sitting around, well, then you may be happy, but the store is losing money. That's why just-in-time inventory systems, we have so much more data today. Like, say, for instance, when you go to the supermarket, they're almost immediately measuring the stuff that you buy. So I'm not measuring it, but putting it into a database. And they do it not just on an absolute basis, but they'll do it at different hours of the day, different times of the month, different times of the year. So now by refining it and taking all that information from the different stores, the overall company can say, well, it's January. You should be carrying this product. It's February. Maybe you should be stocking chocolates and flowers for Valentine's Day. Hey, guess what? It's July 4th. You need hot dogs and you need, hot dog buns. They know, and this is how much you should have given where you are and who normally shops in your store. So these are all things that are really important that you measure, because they're important metrics for your company. Okay. So inventory turnover and understanding how much inventory you have is a crucial part of this process. Okay. Any questions? Like, I just saw something recently where one of the secrets of Costco is that they only carry, now this is where you say by understanding finance, it is really one of the keys to Costco. If you go into Costco, and we all probably know about Costco, right? You only have one of everything. It's not like, Noah's Ark where you carry 2 of every animal. You have one of everything. I have one kind of, sometimes coffee, there's a few items where they carry more than one, but mostly if you're looking for something, you basically got one, maybe 2 choices. The reason why they do that is because first they can cut a better deal by just having them become bigger and bigger suppliers, which they become sort of captive suppliers. So they get a better deal, and they know that the stuff is always going to be there because this is such an important part of the business of whoever's supplying. But the second part is they generally have to they don't pay for these products up to like every 60 days, but because they only have one of every item, they turn over their products like once a month. So think about it. They're not paying for it for 60 days, but they're getting their money back once a month, maybe once every month and a half. So they're always positive cash. If you think it out and you take a minute and think about it, it's a positive cash scenario for them. They're turning over their inventory. They're turning over their inventory faster than they're paying for their inventory. That's like very rare. Walmart has an 8 times conversion ratio. Costco has up to 12 time conversion ratio. So Walmart actually has to lay money out, right? Depending on the terms of their credit terms. But since Costco turns over their inventory faster than they pay for their inventory, because they're always delaying their payment because they have credit, that's a positive cash flow to them. And that's a secret to their business. So they're never going to want to offer you 5 types of tomato sauce or canned tomatoes, or 3 types of cinnamon, because part of their secret is that they have a positive cash flow. And it's a big number when you multiply it over all the stores that they own, right? Same way, like when you go to a supermarket, I'm going to go to profitability ratios now. When you go to a supermarket, you everybody pays the minute you check out, right? Everybody pays the minute you check out. However, everybody pays the minute you pay, but they don't pay for this stuff for 30 to 60 days. In some cases, up to 60 days that they give them proper shelf space, because it's all about shelf space. So they're making, that's a big part of their company, because if you sit there and think about all the money that flows in every day, and they can cut better terms with their banks because they've given them so much overnight cash, they only have to pay this. At that point, they pay their salaries and their upkeep and their overhead for their stores. They're getting positive cash flow. So these are things that you don't think about, but that's the way businesses run. Okay, so the profit margin is going to be your net income over your net sales. Your profit margin is going to be how much income you're making on net over your net sales. Okay, so I want to know, based on my sales, how much am I making off these sales? 10, 12, 15%. Again, what you want to do is you want to look at it as a function of your peer group. And then if I want to just look at the net cash, not just my income, but how much cash am I generating, right? Before I even take out my operating activities, my sales versus my cost of goods sold, that's going to tell me how much cash is coming in. So I want to definitely keep an eye on my cash flow, because that's how I'm going to pay my bills. Because ultimately, if I look at net income, I'm also taking out all my expenses too, right? So I have to pay people, I have to pay overhead, I have to pay accountants, I have to pay people that are part of my firm's administrators. But those, if I see my cash returns are good, but my profit margin may be not as good, maybe I'm carrying too much overhead. And that leads to some real important questions. Do I need all this overhead, or are those things I can do without? Then I have my asset turnover, which is my sales over my assets. Now that's your general assets. And this is a tricky number, because sometimes people, firms will need factories or trucks or PCs to make money. Okay, we get that. We understand that. But all of a sudden I have two companies, and one company has a much better asset turnover. I don't stop there. Because what I might be saying to myself is, hey, wait a minute. What are these assets? Now, if two companies in the same industry and one company is doing much better, I wouldn't stop there. I would ask the question, well, what's the age of those assets? Well, maybe the company that looks so much better has very old assets and they're very low value. So if they're very low value, what's happening is I'm getting a great turnover, but it's not helping me. You know what I mean? I have assets that aren't valued as high as they should be. Whereas the other company has brand new assets, and their numbers are going to look more sluggish. Those are questions you have to ask. That's why ratios are just the beginning, right? And then your return on assets, same problem. One company may not look as good as the other company, but they got brand new assets. They're going to be more efficient. They don't have all these costs coming down the road. And then you have return on stockholders' equity, which is your net income over your average stockholders' equity. Now, remember, what is stockholders' equity? And again, these are all things you're going to deal with in the homework. So remember this, or watch this video again, or watch my video on financial analysis. You're going to have your assets, right, on the left side of the balance sheet, minus your liabilities on the right side of the balance sheet. And that's going to be what you're worth, which is your equity. That's what the company's actually worth. So how does my net income look like over what people own in my firm or what I own? Important number, because I want to see what my return is on the money I've invested. So, again, if I'm doing much better on my equity, well, that's going to be a good situation, because my company is worth X, but those assets are generating much higher returns. Now, again, if you understand accounting, maybe one company looks much better than the other company, but they're using a lot of debt, right? So the equity goes down, the debt goes up, you have more leverage, and that's a good thing, right? If you're very profitable and you're using a fair amount of debt and you're making more money because you're borrowing money to make more money, and it looks really good against your equity. Of course, it's like buying a home. Think about it that way. I buy a home for $500,000 and I only put up 50, right? If I only put up 50, I've got like 450 in debt. So if that house goes up $100,000, I just made 200% of my money because I borrowed a lot. But if the houses go down in value, I could get wiped out after 50,000. Whereas a guy who put up maybe 200,000, has 200,000 equity, has a lot more leeway. So just saying that my return over equity is good doesn't answer the question. The question is, how much debt am I carrying? Why does that number look so good? How much equity am I dealing with? Those are all things you want to consider when you're looking at those numbers. And then I have my return on common shareholders' equity, which is my net income minus whatever preferred dividends, because those are fixed expenses over my average equity. So all we did here is we take out preferred dividends, because those are dividends I have to pay. Then I have earnings per share, which is my net income over my average common shares. Very important number on Wall Street, because what is my actual shares earning? That's how we're going to determine price earnings ratios and things like that, right? All of those metrics are going to be a function of what my earnings per share is. All of my prognostications by analysts, whether the company looks profitable, are all going to be about earnings, net income over earnings per share. So how much am I earning per share of stock, right? If I have 1 million shares outstanding and my company is making $10 million net income, then I got $10 earnings per share. That means for each share of the company that I've given out for all my partners, because think about it, what are shares? They're shares of a company. How much is each share being earned? How much earnings are attributable to each share, and what's that ratio? Okay. Okay. And then we talked about price earnings ratio already, which is the value of their stock, and why people pay particular attention to price earnings ratios is because it deals with the market value. Now this is actually what the market thinks your company is worth. So if your company is worth $100 and your earnings are $20, right, then you got a 5 PE. But generally speaking, the market has been very highly valued over the last number of years, and we're looking at PEs of up to 24 or 25 times earnings. So when you go to Yahoo Finance or anywhere where you look, one of the key numbers you want to look at is always price earnings ratio. And I'll show you that in a minute. And then finally, what are the dividends that the companies are paying out versus their income? Because once you make money, there's only two things you can do with that money. You could either pay it out in dividends or put it back in the company, right? So if your dividends, that's just one function. So that gives you an idea of how much money is being returned to investors, how much money is being kept back, how much money is being kept into the account, retained earnings account, to generate new income. And finally, we have solvency ratios, which is our total debt over all our assets. So we always want to keep an eye on that number. Generally speaking, a comfortable number. You got to look at your peer group again. Is 75% equity, I would say 70, 65 versus 30, 35% debt. You don't want to see more than that, because you don't, and even in your regular life, you don't want to have so much debt that can cause an issue for you. And then you have your times earnings times interest earning, which is your net income over taxes and your interest expense over your interest expense. It's your net income over taxes and your interest expense over your interest expense. Okay? I just want to do something here. And that's a solvency. So you add back your interest expense. And that's what that is, okay? All right. Just give me 1 minute. I just want to take a picture of that. So it's your net and your interest expense. You add back your interest expense. So that can be tricky sometimes. So just remember you add back your interest expense. And finally, your net cash from your operating activities over your liabilities, which really is just another function of how much cash do I have on hand to pay my bills. So let me close this. And again, what you want to do is you want to look for trends. You want to look for trends over different years. And you want to look for trends in your income statement over different years. And that's how you're going to identify whether things are going along the right way or you're having issues. Just like, again, like when you go for a blood test, they don't just look at your absolute numbers. They look at it over time. Try to think of it that way. Okay. So that's about it for today. Any questions? Where are you guys? Any questions? Any questions on anything we did? Any questions?
I don't have any questions.
All right. So what I want you to do is, remember to go over the ratio analysis again. Remember that horizontal analysis looks at it over a period of time. Remember that vertical analysis looks at things over a specific period. And that should get you to where you want to go. And as you're doing the McGraw-Hill stuff, watch the videos. Make sure you read the chapters ahead of time. Don't just don't dive into the exercises. One thing I did want to show you guys. And if you don't see my screen, I'm going to be showing you the Yahoo Finance page. So if you don't see it, let me know. There we go. So when you go to Yahoo Finance, which is a very good site, really, it really is. And you look at, say, Ford Motor. You'll notice that their price earnings ratio is right here. It's about 11, which is much better than the market. And then beta, we'll talk about in later classes, is a function of how your stock moves against the market. It gives you market cap, which it's unbelievable. It's only a $42 billion company, and I'm going to tell you why it's unbelievable in a minute. And there's your earnings per share. And there's your estimate on earnings per share. So for some reason, Ford has just really been a stock people just love to hate. But then when I look at something like Netflix has a PE of 43 times. So the market's really saying that Netflix is going to keep growing and they're going to pay these high PEs for it. Or if I look at something like Nvidia, which has really gotten crazy. That's just a crazy stock. I tell you, I look at it and I shake my head sometimes. And then usually when I shake my head in time, something happens to show me that I wasn't crazy. 74 time PE. So you get an idea of, just by looking at this site, you get a good idea of the kind of stuff we're talking about in this class. Okay. So if there are no other questions, I'll let you guys go today. It's a nice summer day. Enjoy the beautiful weather, and we could talk. Send me any questions that you have. But again, read the chapters again. Don't just use my video and all my stuff. Those are good. Obviously, it's why I made them. But also use them in the context of the work that you have to do. Watch the videos. More information is better in this case. Because the one thing about accounting, this is what it is it's a little painstaking. It's repetitive. It's like basic math. You have to keep doing it so you remember how it works. Even something like that times interest earned. Sometimes I've got to remember that I got to add the interest before I do it. Okay. All right. Any other questions?
Professor,
No questions. Thank you so much.
Nope.
Oh.
Yes.
Oh,
Tan,
sorry. You said the keyword this week was liquidity.
Liquidity.
Okay, liquidity
is the keyword. All right, guys. I'll see you next week. Keep going.